When people think about paying down debt, the first question is usually,
how fast can I get rid of it?
but a better question is, and the one we're talking about today is,
How do I pay down more efficiently?
What do you mean by that?
today we're going to walk through how people typically think about debt and the key concepts that often come into play. Hi, my name is Cecilia Nelson with Nelson Law Strategies. And before we begin, a quick disclosure.
Come on now, dog. Come on, man.
This video is for educational and informational purposes only. It is not intended to be financial, tax, or legal advice. Everyone's financial situation is different, and any debt management strategy should be evaluated based on your individual goals, income, cash flow, and overall financial picture. The examples discussed are general in nature and are not recommendations. There is no guarantee that any strategy discussed will be effective for every individual. With that in mind, let's get into the concepts. Now, before we get into paying down debt, let's talk about what debt is to make sure we understand this. If you already understand this, feel free to skip this part. Debt is money that is owed, typically to a person or business, which is typically considered a liability. Liabilities can be broken into different categories, such as current liabilities, which means the debt is short term, like typically paid within a year, which these can be considered wages payable or dividends payable. Non-current liabilities, also known as long-term liabilities, which means the debt will take longer than a year to pay off, like a car loan or a mortgage loan. Now that we have gotten that out the way, let's go into why we're here. When we talk about efficiency, we're not just talking about paying the smallest balance first by throwing every dollar at debt. Efficiency often means balancing interest costs, cash flow, flexibility, and risk, not just speed. Two people can have the same amount of debt and still require very different approaches depending on their income, emergency reserves, business ownerships, or upcoming life events. For example, you'll often hear about two common ways people think about paying down debt. One approach focuses on prioritizing higher interest balance to reduce the overall cost of borrowing over time. Another approach focuses on smaller balances first to create momentum and behavioral consistency. Neither approach is inherently wrong or right, they're just simple tools. What matters is how they fit into someone's broader financial framework, including savings, income, and future goals. One of the biggest mistakes people make is focusing on balances and ignoring cash flow. Efficient debt management isn't just about eliminating debt. It's about ensuring you'll still have flexibility to handle emergencies and invest in opportunities or navigate income changes. A strategy that looks good on paper but strains monthly cash flow can actually create more financial stress over time. Here's a way to look at it. Sarah has $100,000 in assets, but also has $100,000 in liabilities for the sake of consistency of this topic. Debt, we'll call it that. Joe, on the other hand, has $0 in assets, but also $0 in debt or liabilities. Who is in the better situation?
A few moments later.
It depends on how you look at it. Both Sarah and Joe have a net worth of $0. Joe is considered to be debt-free, but he doesn't have any assets either. Most would say Joe is the winner in terms of net worth, but not so fast. Sarah might be in $100,000 worth of debt, making her liabilities high, but she also has $100,000 worth in assets. Most people may say Sarah should just pay off all the debt like Joe so she can eliminate all the debt and, like him, just start over. But let's be honest, that's not how life really works. You only have emergencies when it's convenient.
Bruh.
Right. You only come across investment opportunities when everything is lined up perfectly. Yeah, guess again.
I got you, homie.
If Sarah needs to seize an investment opportunity or need money for an emergency, she can leverage the assets that she currently has. And before I go down a deeper rabbit hole, let's talk about what an asset actually is. An asset is a resource that possesses monetary value and is expected to provide future economic benefits. Assets can be broken into three categories. Number one, current assets. These are resources that can be converted into cash or cash equivalents, usually paid within 1 year. These are like prepaid expenses or just plain cash, where we're talking now regular cash flow. Number two, fixed assets, which are resources within an expected life of more than 1 year, such as like equipment or buildings. is usually used for accounting adjustments and also known as depreciation. Number 3, intangible assets, which are economic resources that have no physical presence, such as patents or trademarks. And of course, we can go into other categories, but we'll keep things simple. Now, back to the program. One of the most common misconceptions is that there is a simple, best way to pay down debt.
Stop the cap. Stop the cap right now.
But in reality, the most efficient strategy is highly personal and can change over time as interest rates, income, and life circumstances evolve. What works during one phase of life may not be appropriate for another. There are many factors that come into play when deciding to tackle debt. Number 1, interest rates. Not all debt is made equally. Some debt is static, but other and most debts accrue interest. Evaluating interest rates may help you prioritize what to tackle first. Number 2, timeframes. Another thing to think about is the time frame of debt owed. A lot of the time we get a loan for a house or a car, we have to pay the debt back within a certain time frame. Usually a house, it's 15 to 30 years, and a vehicle is anywhere from 24 to 60 months. There are usually penalties of late or missing payments of this debt, which can lead to foreclosure. Number 3, income changes. We can make plans to tackle debt a certain way, but changes in income, whether good or bad, can change your plan overnight. And that's okay. Financial plans are not meant to be consistent with no change. As people change and adapt, you should also change your debt planning. Number 4, goals. Paying down debt may actually be a goal, but is it the only goal? When creating a plan to pay down debt, you must consider other goals like saving for emergencies, saving for kids' college, saving for your retirement. You can't pay down debt all at once and still give all of those goals the same attention. And lastly, number 5, circumstances. As mentioned, you can plan life as much as you can, but you can't predict it. You can have the goal to pay off debt by a certain time frame, but as you know, life always happens unexpectedly.
Oh no.
Overall, debt decisions should support long-term clarity, stability, and confidence, not just short-term relief. Understanding the concepts behind efficiency allows you to ask better questions and make more informed choices. If you found this breakdown helpful, feel free to like or subscribe for more educational content focused on intentional financial planning.